Hi guys, welcome back to Earthnova. So, people tell you FDs are bad, they don't beat inflation, etc. etc. So, I'm gonna tell you about something that gives you FD level safety and slightly better post-tax returns than FD. So, today we'll break down what arbitrage funds are, how they work, how they can outperform FD level safety, and where you still need to be careful. Exit load, taxation, and all the good stuff. So, let's decode this step by step. Part 1. What is an arbitrage fund? The word arbitrage simply means risk-free profit from price difference. Imagine a stock trading at 100 in the cash market and 101 in the futures market. When the contract settles, both trades cancel each other out, locking in that 1 rupee price difference as profit. These funds keep doing it hundreds of times across stocks, generating small safe spreads together that together yield around 7 to 8% annually with near zero market risk. Part 2. Why they are safer than you think. Every arbitrage position is fully hedged. There is no directional market risk. Even if the market crashes, the long and short positions cancel out. So, volatility barely matters. Returns mainly depend on liquidity and the price difference between cash and futures markets. And that is why SEBI classifies them as equity funds, even though the risk is closer to overnight or liquid funds. Part 3. How it beats FDs legally. Let's say both FD and arbitrage funds earn roughly 7 to 8%, but taxation changes everything. FD interest is taxable every year at your slab rate. If you're in the 30% bracket, 30% of the gain gone right away. Arbitrage funds, being equity oriented, are taxed only on capital gains, not yearly accruals. If you sell after holding for 12 months, you pay 12.5% in long-term capital gains tax. And you also get a 1.25 lakh long-term capital gains exemption per year. That means the first 1.25 lakh rupees of profit is completely tax-free. Part 4. 10 lakh rupee investor. Let's take a realistic middle class example. Let's say a person has 10 lakh rupees to invest. So let's say both of them give you the same amount of return, 7.25%. In FD, that comes out to an interest of 72,500 rupees, taxed at say a 20% tax slab. That comes out to 14,500 rupees. Net gain 58,000. A gain of just 5.8%, which doesn't beat the inflation of 6%. In an arbitrage fund, the same 7.25% gives 72,500 rupees, and due to the exemption, there is zero tax. Net gain 72,500. That's 7.25% return, beating inflation. Part 5. Exit load and liquidity. There is one caveat though. Arbitrage funds have an exit load of 0.25 to 5% if you redeem within 15 to 30 days. After that, redemption is T plus 1 days, nearly as liquid as a savings account. So always hold your arbitrage funds for more than 30 days, ideally at least a few months, to avoid small exit penalties. Part 6. Example, 1 crore investor. Now let's scale this up for the bigger investor. 1 crore in FD at 7.25% generates 7,25,000 rupees. 30% tax, that's 2,17,500 rupees. Net 5,07,000. That's 5.07% post-tax. And let's calculate 1 crore in arbitrage funds at same 7.25%. A net gain of 7,25,000, 1,25,000 exempt, so 6 lakh taxable at 12.5%. So that comes out to a tax of 75,000 rupees. That comes to a net gain of 6,50,000 or 6.5% post-tax. Similar safety, more efficiency. So let's move on to the key takeaways. FD level safety, check. Equity taxation, check. 1.25 lakh capital gains exemption, check. Slightly better post-tax returns, check. As long as you hold for greater than 30 days. And that's how you can replace FDs from your portfolio smartly without gambling in the markets. If you want our help with mutual funds, there will be a link in the description below. Check it out and register with us for a free account. And if you found this useful, share this with a friend who still believes FDs are unbeatable. This is Saransh from Earthnova, helping you make your money work smarter.